When it comes to the Asian session liquidity, there are different ways of trading it, and in this video I'm going to be showing you one of the easiest ways you can effectively trade the Asian session liquidity. Learning to trade these patterns is the most important skill you will need when trading forex, because the Asian session liquidity is the backbone of the forex market. And if that sounds interesting, let's get to it. Now, when it comes to the Asian session liquidity, there are basically three main patterns to look for. Now, I've explained two of the patterns in my previous videos. You can check out the playlist on Asian session liquidity on my channel, and you'll see the two types I've explained. I'm going to be explaining the last one, which is the final piece of the structure. Now, this pattern is basically very simple actually, because it's almost like a combination of the first and the second. It's more closely similar to the first one, right? So we know the first one, you have your consolidation here. The market makers consolidate, and then coming out of the box, you have a breakout of the box. Basically, have your M formation, and then they reverse back and end in consolidation like this, right? Now, the pattern, the second pattern is you have your consolidation, and then you have your breakouts. You have your breakout out of that place, they come back, and then they continue, right? I explained that in full detail on the playlist, but the one I'm going to be explaining today, this is how it works, right? You have your consolidation, and after consolidating for like about 8 hours in the box, coming out of the box, right, you have a volatile move, a hard push towards the high. In this example, the high of the Asian range, the top of the Asian range right here. Let me just draw this out as a zone. So you have your zone here, right? You have the top of the Asian box, and they head towards that zone aggressively, and then they pull away from that zone, and then they go back there, form an M formation. What they are basically doing is they refuse to go above this box. They are refusing to go to this area right here. And we know that the normal type of the structure is they'll break out of this zone, break out completely of this Asian box, and basically form the M formation like that and reverse, right? But in this scenario, in this pattern, we don't have a break out of the box. We just have the M formation coming out of this box during London session, right? And then they form the formation and they reverse like that. Also, this is also the same for the W formation. It's just upside down, in inverse basically, yeah. So you have your W formation, basically something like this. Sometimes you have the first leg inside the box and you have the second leg outside the box like this, and sometimes you have both legs outside the box, but you won't have both legs inside the box. If you have both legs inside the box, that means that is just consolidation, right? And then you wait for them to go and head towards the high or to the low of the box and form your M and W formation. Why that they refuse to break above the box? Because you might be thinking, why don't they want to break above the box? I thought breaking above the box was them inducing traders to take a sell or take a buy, right? Yes, them breaking outside this box induces people to buy, to take a buy, also hitting the stop loss of those who took sells all the way in here at the resistance, right? But now they refuse to break the high or the low. Why? Is because when they form this M formation here, so they refuse to break above, right, to go all the way here, because they have enough liquidity already, probably from the previous day, right? They have enough liquidity already from the previous day, so they don't need to go above this zone. They don't need to go above there. They are okay with what they have, and they can move away from this area as quick as possible, right? And not only that, sometimes you won't have a break above. What they'll usually do sometimes is, if they actually want to take this liquidity here, what they'll do is they'll just throw a shadow up here like this, or a bunch of shadows or wicks above here like this, but they won't break it, right? And then they will just reverse from there after taking out this liquidity. So they are basically not inducing, what they are just taking out the liquidity. Unlike the first one is they are actually breaking above and inducing, right? Getting people to buy. But in this scenario, they're just hitting the stops. Sometimes they won't even hit the stops, they'll just go away from that area. Why it's like that is because of it's mainly because of the main structure, right? So if they were in an uptrend, right? Let's say they were in an uptrend, market was in an uptrend, and then they reversed. Let's say they formed an M formation like this, and then they reversed, right? Now, M formations are used to trap traders, right? Because there are traders who took sells here and who took buys here, took sells here, right? Now, there's a bunch of orders inside this area like this, and because they don't want to go, if they go above this area, they will have, that means they are going to release the people that they trapped the previous day in this M formation, because they're about to reverse the trend, right? And now they have to go away from that area as quick as possible and leave these people trapped and to finish them off, right? So this, for them not breaking above here, is to finish these other people that they trapped here the previous day, right? It's you have to look at the main structure of everything, right? And then they'll continue down like that, and that's why they don't break above the structure, right? Same thing for the third one too, the third type of structure, where they just break out like this and then they come back and then they continue. They don't want to go above this to release the traders, if that makes sense to you guys. Now let me show you guys a couple of examples here, and we can see this type is not really as frequent as the normal type, where you have breakout, reversal, and end the day in consolidation. Breakout, reverse, end the day in consolidation, right? You can see this type almost every day. Now this one you won't see it almost every day. It comes just a select few times. Here we have an example here. We have consolidation, we have the Asian box, we have the top of the box, and we have the bottom of the box, right? Now we can see they come to the bottom of the box. This is our first leg. They consolidate for a while and then they come back. This is our second leg, right? And you see they don't go up below this zone. If you change this to a line chart, you can see this is a W formation right here, like this, right? Now, we also have the macro. We have the M formation like this, right? And you can see, like I said, they will just throw some wicks above. Even if they closed above here, it's just a little close. They didn't really go out of this area, right? So they just stayed above. They stayed below the wicks, right? So they just threw the wicks and stayed below the wicks. They didn't close above these wicks. So this behavior is them hitting the stops and then they move away from that area, right? And then you have your big M formation like this. Let me see if I can find another example. Okay, here's an example here. We have our first leg inside the box, and then we have our second leg outside the box. You can say it like this, or you can say this is your first leg of the M and second leg of the M, and you can see they don't break above this area. Let's look for another example. Here's another example here. We have our Asian box. You can extend it, the highs and the lows. You can see you have your first leg and you have your second leg. Now both legs are inside the London session. Then we didn't have any leg inside the Asian session. And you can see they refuse to break this high. They just threw this wick just above. And they can also open the spread. Yeah, they can open the spread maybe like 5 pips, 6 pips above to take out any orders that are there. All right. Okay, previous day we still have the same pattern. We have our Asian session first leg, and we have our second leg coming into London session, and you can see they still respect this high, right? First leg, second leg, and then they move down. All right. So this pattern doesn't really happen every day, but if you know how to trade the three patterns, then you should have at least 10 trades per week with three patterns. If you don't know how to trade the three patterns except this, all right, so the remaining two, check out my playlist on Asian session liquidity, and you will have a proper understanding of how to trade all the patterns, the structure behind the patterns, and why they form those patterns. And I'll see you on the next one.